Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long short report covering all asset classes.
Hi everyone, this is the 29th of July 2020 and we are heading right into the final week of expiration, which ends tomorrow for the month, and then that's also the month end on Friday. So you have the weekly, monthly closing on Friday, and we'll start off completely into a new series. So what's ended up happening though is last week we were in a tight trading range and we broke out of that by moving above 11,240. Now the case is going to be whether we're going to hold that or not. In the morning we retested that support and so far are holding on to those gains, and if we do, then we should then go towards the 11,400 mark, which is the 78% retracement of the entire fall. Now that might just be the first hurdle, but I do think, looking at the kind of rotation you're seeing in the market, that this continues to extend on the upside, which is what has been happening since I think the low we made in May. Is that rotation from one stock to the next or sector to sector has kept the index being propped up after every few days. So you have these 4-5 day rallies and then you get a consolidation, another 4-5 day rally, another consolidation. And I think you're into another of those phases. So another 4-5 days and then we look at where you consolidate again. So it could be anywhere between 11,400 to 11,800 in terms of the next levels where we could look for that. But till you've actually paused or reversed, I think we should continue to expect more upside. So that's the basic outlook for the Nifty. What you are seeing though, every time the Nifty pauses, you see the Bank Nifty sell off much more. So it moves 2-3% a day on the upside, but also sells off similarly on the downside. And in doing so, it's actually not made much progress. Now in my broad picture, I have highlighted that India is always around a decade behind what the US is doing. And my point of saying that is that while we saw the inflationary and high interest rate environment very similar to the US of the 70s into the 1980s. In India, we saw it in the 1990s. The same way today, we've been in the midst of our own semi-financial crisis, similar to what the US went through to 2008. Now, it may not be of the same scale, but similar set of events where you have, failures within banking, you have NBFCs going down, you have NPAs and so on, various issues that needed to be addressed either through bailouts or through direct intervention by the central bank. And the central bank having done that, the situation you're in now is that not just the past burden, but also now the burden of the COVID crisis is being taken by the banking sector, which is what happened, after 2009, that you would, put a backstop to failure in the banking system, which is good for banks. But net, because they took the burden of, growing the economy out of providing the liquidity or taking the losses, their performance got hit over a 10-year period. So while banking stocks may have moved up, a lot of, researchers or, hedge funds and various people who write about markets have always looked at these bank indices, especially the KRW bank index, which, highlights that many of the banks that were taken down by 2008 are actually not recovering, and therefore it's bad for the economy. But what it really meant is that the banking sector ended up being the largest underperformer over this time period, not going back to the 2008 highs. That didn't really end the system, but it's simply because the burden had been taken there that they couldn't show the same performance. So they started from a much lower base, which is after having a steep sell-off, they started to move up, which has meant that the rise has been slow and steady and not really been sharp. So in effect, what we are really looking at is a similar thing happening here now. So which is why I think while bank stocks may pick up, you may see the momentum, you might not see the same kind of moves that you're really seeing in the main index. At least so far that has been true. So in terms of retracement, while Nifty is coming closer to the 78% retracement mark, Bank Nifty is not even gone past the 38% retracement mark. So that's the net effect, and I think it remains. But that doesn't mean that you'll get an outright sell-off in banking. But short term, you'll keep getting these knee-jerk reactions and you'll have to deal with the volatility, which is likely to be higher in the financial sector. Now, while this rally has happened, we've also seen sentiment not really pick up. You can simply go by FIA positions. For example, FIA data in terms of net buying, apart from big block deals, is not really taken off. You get these 1 day, 2 day inflow days, and then suddenly the inflows are very, very small compared to any previous bullish period. So the net monthly flows may sometimes appear big simply because of those few block deals that end up happening. Otherwise, you're not getting the day-to-day flows, which is a little surprising to me. And the reason I'm surprised is that I would expect that emerging markets end up being the better performers of this time period, simply because emerging markets have been at the center of the crisis when the dollar was really strong. And now you have a weak dollar environment in which money should eventually flow towards emerging markets, and they should actually perform better than the developed markets, although a large part of the gains have been driven by the US indices initially. We are now seeing a pickup across EMs from those lows, especially in Asia. So that trend should have led to flows coming back, but I think because the environment is such, we are still facing the negative effects of the pandemic, both on the economy and in terms of case counts growing or falling in different regions, that the fear remains high. There was, of course, some study, I think, on Bloomberg Quint that I saw showing that, the animal spirits are still probably pretty low among businessmen, which means in terms of investing and taking actions on the street, they are really not moving full forward, which makes sense because the environment has not changed. So nobody would really be going all in. All you need at this point of is the kind of support that you're getting, to keep businesses afloat. I think that's the first step. And so that's why sentiment really remains negative, even though you have recovered thanks to the monetary and fiscal support that you're getting from various central banks and governments around the world. And that sentiment actually shows up. So people start looking for, whether the market's overbought or whether a particular stock, like for example, Reliance or the pharma stocks, were a large contributor to the index on the upside. But mostly it's been Reliance recently. It's been the biggest single stock contribution. And so will it get overbought? It's gone too far. Will it cause the market to fall? Similarly, people end up looking at things like the put call ratio, where there are a couple of negative divergences. But what happens in a strong trend is sometimes you will get several divergences before a move, and sometimes these negative divergences are indicative of a top, but the top may be only short term in nature. So what kind of a top is the sentiment really indicating has to be read into based on Elliott wave analysis itself, and not purely just because indicators have reached a high that you should get a major sell-off. So that's the first. And the second and more important thing, I think, is looking whether it's happening across the board. So the one indicator which I think I've highlighted maybe in a couple of my interviews, maybe in my previous videos, and I'd probably mention it again, has been the discount or premium that you see in the Nifty. Now today in early trade, you're actually seeing that narrow down or some premium come back. But that's happened a couple of times in the last 2 months. Each time it has caused a short-term reaction. But I have actually been plotting this 30-day average of the Nifty discount or premium over the entire time period from 2007. Where in fact 2002, where you have data of the futures price and the spot price, and I just take the difference and run a 30-day average. And when you see that, you see that today's readings are actually lower than where they were in March. So even though in March you did see, and I'm talking March 2020, you did see a reading of almost an 85-point discount or a 100-point discount on one day. Those happened and then they quickly reduced, and then the discount completely went away by May, and then you had a slight premium. And then since then, throughout this rally, you're seeing a persistent discount. And so that persistence of this discount has caused the average to actually go much lower than where it was in March. Even though the individual day-to-day readings are not going to 80 points, you are getting 40 points, 30 points on average on many days. It was 10-15 points last couple of days, and then it goes back to positive. Then the market reacts thinking that it's getting overbought or the shorts are squeezed, and then again you get negative, and then again it moves up higher. This is what has been happening over and over again. And this persistent discount to me indicates that you have a major negative sentiment that is not yet gone out of the market, and that's why it's driving up higher. So market's driving the fear out, whether it's shorts or whether it's lack of buying, you can argue it in different ways, but each of them means sentiment is too negative, not typically where you see market tops, typically where you see market bottoms. And so it keeps rallying on, fighting out that sentiment with whatever liquidity is available. So that's one big factor. So this is the lowest reading even since I think 2009, because we haven't seen such low readings since then. And so 2009 is the last time you had readings like this. In between that, many times you have come close to zero, maybe gone slightly below it. And that's mostly in the June season, which is a dividend season. But this time's readings are even lower than what you've seen in at least the last 5 Junes. And so this is not only because of dividends, for those who are thinking it's just a dividend discount. Now we are entering August and you still have a discount going. So this is not a signal that, this is the end, but this is really a continued negative feeling that the market has that is going to crash. It's going to crash. One day down, you have a 1% drop in the US markets and people start discussing that the top is in. So that sentiment is what the market's fighting out. But what it's also doing, it's actually looking 1 year forward. So the market's thinking about what will happen post-pandemic. I think everybody knows pandemic means earnings are not happening, GDP growth is not happening, and that's going to mean bad numbers. And if you see the way the street is reacting to the quarterly numbers now, everybody's downgraded their numbers and then they are saying, oh, this is better than expected. So they over downgraded, considering that it's a complete lockdown and there's zero business. And while everybody is working from home, many businesses are showing some business. Maybe they're showing it from, even by booking past sales and data, whatever may be the truth. But the fact is they're showing some numbers and it is showing as better than expected, and therefore is being reported in a very, very different light rather than in a negative light. And so that's supporting the market, and that's a game that you need to understand that markets always play. So they always, end up, discounting what is known because that's already been anticipated. And then they start looking at what might happen in the future. And so that's where I think the reason why this rally continues to go on. And I think if you just follow it technically from level to level, then you'll continue to look at the upside potential rather than consider the downside potential. Now, having done that, I think the last thing that we are going to have in terms of event is the Fed, of course, meeting tonight. But apparently overnight, they also made a statement that they're going to extend their 2 trillion package all the way into December, which was, supposed to end in September. So essentially what they're saying is we are not backing off as long as the market needs some kind of support. We are going to be around. And they're announcing even before they had the final meeting announcements, which will come out tonight. So I guess tonight's announcements will mostly be about the economy not doing well, requiring support and so on. But when I just look at the US indices, I saw that there's a possibility the Nasdaq still, and it's been, after having a big run, its short-term momentum is lost. So it has some 2-3% downside to the 40-day average where I look for some support. And it's also a kind of a flat structure or a zigzag correction, maybe an ABC. And so wave 5 of C could pull down. So the next support for the Nasdaq 100 would be 10,230. That would give you that 2.5% downside. So I don't know, maybe the market reacts negatively to the announcements tonight and then picks up from there. So that could be a possibility as far as US is concerned. But most of Asia was holding up today. India also, if it stays above 240 and hopefully closes positive, then I think the individual market trends probably continue. And we'll respond to that overnight action maybe tomorrow and then resolve it from there. So that's how I'll look at it. But then tomorrow being expiration, it will create some fear among people when you see overnight action negative that expiry is going to turn bad. But you can't really predict that sometimes, and so it's just a risk to keep in mind. In terms of levels, I'll just be watching how well we hold above 10 to 40. I think so. That's the main thing. Otherwise, we should head towards 11,400, 800, like I mentioned earlier. The other big thing which happened over this week or last week is that everyone who's been fighting about the dollar, and still I feel there are few who may still not be convinced, but you've broken the rising trend line from the 2010 bottom all the way up in this week. So that breakdown now marks the start of a dollar bear market. Of course, I've been saying that you're in a dollar bear market for almost 2.5 months. But for everybody who's not convinced, a lot should have changed their mind by now, and those who haven't will probably do so over the next couple of days. So this change of mind should happen and the dollar bear market should start. And in fact, it has started, but it should continue. And even if you're looking for a short-term bottom thinking it's very oversold, I go back to the first thought. Very oversold or overbought conditions don't always play out in a strong trend. It might mean that you get small bounces come out of the oversold or overbought condition, but eventually you'll end up moving much more in that direction. So I think you're still not reached the end point of this move down on the dollar, though it is oversold. So you'll start seeing volatility, one day up and then 2 days down and 1 day up and so on. That might happen till it finally reaches the low that it wants to make for this move. So and once it does, then of course we look for a larger counter trend move. But even in my bigger count, if I'm looking at this being a 5-wave decline from March, I still think that there are a couple of legs left. So even if you do get a 1-2 week rally, I think that would still be a fourth wave in terms of wave structure of the fall, and then there's another fifth of third and a fourth and a fifth left, even at the larger degree. So it's going to be a prolonged decline is what I think. And as in when you get those short-term relief rallies, sure, it may cause a correction in the metal space. But what's happening today is that the metals index, at least the stock index, the BSE metals index or the NSE metals index, is breaking out of a triangle that I actually discussed on in my CNBC interview 2 weeks back. I thought it would break out by last week, but what it did is it bumped out of the range, then went back into the triangle. So I've simply redrawn the triangle. I think you're getting the breakout now today, which means that the metals rally, which I've been anticipating and took almost this 2-month-long triangle consolidation, is finally happening. And triangles are fourth wave, so this is definitely a fifth wave. And triangle breakout rallies can be pretty strong, so it should last for a while is what I sense. So probably August goes to the metals index. So that's those are, I think, the key things to watch out for. Apart from one last idea, that people wonder why this market is going up. It's become very overbought on the PE ratio. That's one of the big discussions. And if you look at the history, yes, many times, near 30 times the market has peaked, but now you're hitting 30 times before even going to an all-time high because earnings have been downgraded, right? And you're getting weaker earnings for this quarter. So that way it will start looking expensive. But like I said, one thing is going 1 year down the line, and second is understanding why we are going up in the first place, because eventually earnings will improve, maybe not next quarter, maybe 4 or 5 quarters down the line. And the key thing driving, and so everybody's watching that, retail investors are making a comeback, this may be bubbly and so on. But what's really happening is, because you're into an interest rate cut environment where rates are falling more dramatically than they have in the past, to an extent where fixed deposits stop yielding as much as they used to, it is driving a search for yield. So this is actually the beginning, I think, of the search for yield environment. It will shift from fixed deposits to other savings instruments eventually, and as all savings instruments start pulling down their rates, whether it's your PPFs or other investment vehicles, more and more money will then start looking out for other revenues, and those other revenues could end up being equities, real estate, commodities, and so on, precious metals, all of which have started to do pretty well. So I think this whole shift is just starting, and this retail momentum, which people think is a sign of markets getting bullish, is just this shift of money. And if that's a trend rather than an event, then it could last and drive a lot of liquidity into the market. And so you think that that liquidity is coming from the US. Like I mentioned earlier, FII flows have been nimble, and the real flows actually this time have been domestic through direct individual investor equity in a lot of small accounts, and I think that could end up being a bigger trigger than most people are realizing. So I don't think you can simply look at PE. You need to look at the market trend and analyze the technical structure and understand what's happening underneath, and try to think a little longer term. Otherwise, markets don't become as cheap as they had in March and April unless there's really bad news. And if you want to buy cheap, you really need bad news. So if everybody's sentiment is negative, stocks have still not recovered in terms of mid and small caps from their lowest points. So there's this big divergence in terms of what the PE is for maybe the Nifty and what it is for the mid-cap indices. I published a chart sometime back showing mid-cap PEs are actually down to almost 19 and maybe a little over 20 now, but still they're at a discount to what the Nifty itself is doing versus a year back or 2 years back when they were at a premium to that. So can we really change things there? So there are a lot of stocks that could be at a discount, that could be cheaper than the market, and that's will remain true only till the fundamentals really change. And when they do, you don't expect markets to be where they are today. So they can only be here when news is bad and sentiment is bad, and that's where people use their counter intelligence to really pick up stocks at lower prices. when everything is known that it's good and sounds rosy, you're never going to get prices as you have had or you're still getting in many cases right now. So that's my overall, I think, outlook. The Nifty still appears to be strong. There could be short-term gyrations, but we are heading higher. The weakest sector likely to be banking, even though it will head up with the rest of the market, so it will continue to drag along. But we've got the metals breakout and the dollar breakdown confirming over the last week, which should be a trend that should continue to drive these prices over the next month. So that's my update for this week. Last but not least, I'll leave you with the idea that we are revamping the Indiacharts website. So if you're visiting Indiacharts.com, you will see a completely new website maybe from tomorrow. And so it may go offline later today after 3:30 p.m. And if that happens, simply wait for the next thing to come online. But if you're on the mailing list, if you're a subscriber, you'll continue to get the updates on email. So do keep an eye on your emails. That's all from me today. Thank you.